Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to do another review of velocity banking. So, what is velocity banking? All it is a debt payoff strategy using your line of credit as your main tool. So, before we get into it, I just want to read this comment that I got on this YouTube channel. It says, "Hey, would you mind emailing me the spreadsheet? It said I'd pay off 11K card in 6 months, but that's so fast. Feels like I'm doing something wrong." And it will feel like you're doing something wrong because we're going to do velocity banking and almost nobody in this country does it, right? Almost nobody. So when people come complain to this channel about how it's a scam or whatever, I'm like, dude, most of the country ain't even doing it anyways. I know that every time I talk to people that I know, like, oh, velocity banking, line of credit, dump all your income. They're not even interested at all. But the funny thing is, you know that they're struggling, right? I mean, you look at the statistics, and most people in this country live paycheck to paycheck, right? Most of them do. And so, when we're talking about debt payoff strategies, like here's the thing. If I were hungry and somebody told me, "Hey, there's an easy way to get food," I'd be like super interested. But a lot of people in this country, they're living paycheck to paycheck, and probably the main reason for that is they got too much debt and they're not even interested. It's funny how that works, right? And so when you show them like, "Hey, this is how easily you could quickly pay off debt," nobody will believe you. Pretty much nobody. At least that's been my experience. Where I tell people in real life about, hey, let me tell you about this thing called velocity banking. They act like they don't even need it. They act like they're too good for it. You ever notice that? Like how people like they're struggling in real life, but then like they take these Instagram pictures about how awesome their life is when in reality it sucks. That's just the society that we live in. Right? So we're going to pay off debt so quickly today that nobody will believe you. And I'm just going to give you some background about myself. You know, when I first practiced velocity banking, I was like, wow, I'm projected to pay off my mortgage in 4 years. Okay. And it's crazy. I'm actually projected to pay it off in three. So coming this November, at least by this November, I'm going to have it paid off. And then 2 years after, I'm going to have my rental property mortgage paid off. So here's the thing. Once that happens, I don't even have to do anything in life anymore. I could just like work a minimum wage job, I think, work at McDonald's, but I wouldn't want to work at McDonald's because it's so hard, right? But what I'm just saying is that, I'll tell other people, oh yeah, I'm sorry, personal home mortgage paid off in 3 years. They're not going to believe me. They'll be like, what? And then they act like they saw a ghost. But we could figure out how to pay off debts faster than the average bearer in by using velocity banking. And we'll go over that today in this simulation like we always do with this Excel spreadsheets. So we're going to do velocity banking. You really only need two things. Number one is a budget. So all a budget is a debt payoff plan because that's what velocity banking is for. You pay off debt, and the more debt you pay off, the more cash flow increases. So you have an income, expenses, leftover savings, and then when you do an expense breakdown, you have to list every single debt that you have. The more debt that you pay off, the more cash flow you get, right? And we're always going to assume that we have these fixed general expenses, so this will never go away, right? And before we get started, I just also want to show that even though some of you might be thinking, "Oh my goodness, $140,000 of income, that's a lot." That's actually not as much as you think it would be. Like if you take a look here at this home affordability calculator and you put $140,000 of income and you put it all of these debts that you have, like two credit cards, an auto loan, a student loan, right? So that's $2,330 of these payments. Um, Zillow says the most you can afford is a $250,000 house, right? So if you ever see people with like 400 or $500,000 homes and they're not making, let's say, like about 200 or at least 250, I think, I don't think they'll be like, they're probably struggling. You know what I'm saying? In fact, let me just see what we can afford at 250, 250,000. Oh, we can at least afford a $600,000 house, but if we make 140, we can only afford a $254,000 house, right? So you need, if you want to afford the $500,000 house, you probably need a really, really, top of the line income, or maybe two people who make six figures, right? But your average person, even if they make $140,000, they shouldn't be like buying homes at the $300,000 range, right? Isn't that crazy? That's why a lot of people are broke because they overpay for housing. Okay, so that's why in this simulation we're just going to say we have a $200,000 mortgage, right? So here, if you put a $40,000 down payment, that's about 210. We'll say about 200 is a good number, and again, we always want to buy properties at discount because that's the easiest way to wealth, and that's what I've been doing with my own investment property. But I'm gonna we're gonna forget that for now. But my point is that even if we make this good income, it's not we can't really afford as much house as much people will think, right? Like the fact that we make $140,000 and we can't afford a $300,000 house, people don't really understand that. Okay, but let me go back here. So let me actually redo this. All right. So we did our budget, and then step number two is making sure we have the line of credit as our main operating account. Okay. And what is a line of credit? All it is a financial tool where you can borrow money, pay it back, and use it over and over again. That's all a line of credit is. So if you have a credit card, it's a line of credit. There's personal lines of credit, home equity lines of credit. You want all of them. I have over $279,000 because I know the secret, and I always tell you the secret to getting credit in pretty much every single video on this channel, which is that you get it when you don't need it because banks don't lend money to people who need it, right? They don't. You go to a bank and you tell them, hey, I need this money, they're going to laugh you right out, right? So if you want to do this strategy, make sure that you have a firm financial foundation and understand that you don't get credit when you need it, you get it when you don't need it. You see what I'm saying? All right, so now let's go ahead and do this and assume that we have access to a home equity line of credit and for we'll say 9% interest rate and let's say a $50,000 limit, okay? $50,000 limit. So assume that we have like a $50,000 kind of like a credit card based on the value of your home minus the mortgage, right? So they call it home equity. And anytime you provide collateral to a lender, in this case, which will be home equity, they'll give you better interest rates and more limits, right? That's why we can get this $50,000 line of credit at a much lower interest rate than, let's say, a credit card. And the cool thing is that I can use it to pay anything: student loans, mortgages, anything, right? Anything. That's the beauty of it. You can't do that with the credit card. All right, so now let's go ahead and assume same income. And this is the one of the most important parts. And this is where a lot of Americans feel uncomfortable doing this because we're conditioned by society that we need, a few months of savings in order for us to survive. In fact, I told my mom that I don't have any savings, and she was like, "What are you talking about?" Right? But she doesn't know the strategy. I try to explain it to her. Goes one year out the other. You know what I'm saying? All right. So what we're going to do is do the exact opposite of what Dave Ramsey teaches us to do, which is have zero savings. Okay. And let's go ahead and copy this and copy some of these expense figures or all of these expense figures. And what we're going to do is have something called cash flow, which is income minus expenses. Now, in this column, which is the velocity banking column, it looks very similar to the average American column, right? And the main difference between the average American and the velocity banker is that the average American uses their checking account to pay for things, whereas the velocity banker uses a line of credit as their main operating account, right? A line of credit, okay? So what we need to do is we're going to make this line of credit as our main focus of our debt payoff. And what we're going to do is move these two credit cards into there, right? So that's $37,000. We're going to move $37,000 into this $50,000 home equity line of credit. And guess what happens simply by doing a debt transfer, right? This goes to zero and this goes to zero. So now we increased our cash flow from 970 to $2,527 in one swoop without making more money. You see how this income number still stays the same? So here we're a little bit, I don't want to say struggling, but we're not doing as well as we want to be, right? We only have $970 in savings. Whereas here, we still make the same income, but we went from 970 to 2,500. It's a much better number, right? And we did not make more income. Again, this income number is the same, but we achieved it by having zero savings and doing the exact opposite of mainstream personal finance. Okay. And so the actual strategy itself is you put your entire $7,000 paycheck into this line of credit, expenses out, and then after every single month, the balance is going to go down by 2,500 plus the interest, right? And let's go ahead and calculate the next month, which is the previous month plus 1. The next month's balance is the previous month's balance plus the previous month's interest minus this cash flow number right here, 2527.59. And then, so now we got to calculate the interest because the interest is calculated after every single month. We get the average daily balance, all right? So the average daily balance, which is how the interest is calculated. So use this average function to be able to estimate it. Multiply it by the interest rate, which is 0.09, and then divide it by 12, which is the monthly. I'm sorry. So 0.09 is the annual interest rate, and to get the monthly interest rate, divide by 12. All right, so now let's figure out how long it takes us to get rid of these credit cards. So it's going to take us about 16 months. All right, so 16 months to get rid of it. So a little bit more than a year, not bad. For how much credit card debt? 37,000, right? 37,000. So 11K in 6 months, 37. It's about the same, but will it feel like you're doing something wrong because you're paying it off that quick? I don't know. All right, so let me go back down here, which is month 16. Okay, so month 16, so 37K, 16 months is when we paid off these 2 credit cards. And now we have an auto loan, student loan, and mortgage. So we got these 3 loans. Now, how do we know which one we should pay off or focus on, right? And what I like to use is something called the cash flow index. And I started falling in love with the cash flow index when somebody sent me their spreadsheet of numbers and it had 15 debts in it. And I was like so overwhelmed. I was like, which debts do I pay off? And because there's this formula called the cash flow index created by Garrett Gunderson, um, all I think of it as like a ranking system, and all it is a simple formula of the loan balance divided by the the what's it called, the monthly payment. So 22000 divided by 415.17, right? This one is 33000 divided by 358.14, and then this one is 200000 divided by 1199.1. And then as you can see here, ignore the formatting. This is the lowest number. And so what does this number mean? It basically is talking about efficiency, and the lower the number, the less efficient it is. So if it's lower than 50, you should pay it off, and then over 100 means it's efficient. So what do we mean by inefficient or efficient? Well, think of it like this. Would you pay $22,000 to get $415 back, or would you pay $33,000 to get $350 back, right? We want to pay out $22,000 because we get more bang for our buck, right? Like it doesn't make sense to pay off this 33,000 first if we're only getting a $358 payment back, right? So as you can see from this, this is the one we want to focus on first. So we'll focus on the auto loan, even though it's technically a lower interest rate than the student loan. Okay, so let's figure out at 16 months what is the balance of this auto loan. So we go to this loan amortization calculator right here. We go here, and then let's just fill this in. So 22,000 at 5%. So 22,000 at 5% for about oh yeah, it's a 5-year loan. I keep forgetting. Okay, 5-year loan. All right, so at 16 months, then now it's 16,000, right? So now we just copy and paste it right here. All right, so now let's calculate the cash flow index here. So 16659.05 divided by 415.17. Okay, so again, anything under 50 is considered to be, quote, inefficient. I'm not going to really go over that in too much in detail, but I think it's safe to say that we can move this into the line of credit, and it's okay to move it and increase our cash flow by $415. So let's go ahead and do that. So we're going to move this right here, plus 16,000, bam, right? And then what is our new cash flow number? It is almost 3,000. Oh my goodness, 2942.76, right? So now what we got to do is after we move that loan right here, or is it, yeah, right here, we got to increase this cash flow number to 29,942.76. Okay, so now we just copy this and see how long does it take to pay off. 22 months, right? So 22 months, we pay it all off. And how much is that? So that's 37 plus 22, which is 59K. 59K in 22 months. Okay? And then now we focus on the student loan. So let's focus on that. So that would be at 22 months. So 33,000 at 5.5. 33,000 5.5 for 10 years, because the student loan is usually 10 years. And then we figure out at 22 months, what's the balance of the student loan? 22 months, so that would be 28,000. Okay, 28,000. Now let's calculate the cash flow index here. 28222.61 divided by 358.14. So again, it's above 50, so it's kind of not in that, it's not below 50, which means inefficient. So we might, if it's above 50, okay, and I need to kind of flesh this out a little bit better. But basically, like, we don't necessarily have to put the whole thing into the line of credit because we're getting such little cash flow for that 28 grand, right? So if we really want to save interest, I think it would be best to do what we call the chunking method, which is move parts of the what's it called, loan into the line of credit. And we'll definitely do this with the mortgage. But you know what? I'm going to be lazy for now, and we'll just move this into the line of credit. But I'll demonstrate that with the mortgage. So let's go that here. And we'll move this right here. So 28,222. So for that 28,000, okay, we got $358.14 back. And now we have $3,300.90 of cash flow. So now what we got to do is go back here. Wait a minute. Hold on. Did I screw up? Why does it say 29? Oh, no. Okay. So I didn't screw up. My bad. I did it right. So 3300.9. So what we got to do is do 3300.9, right? All right. So in 31 months, right, 31 months, we're going to have the student loan paid off. So 33 plus 59. So 92K paid off in 33 months. Okay. So now, actually, let me just check, because every time I go back and forth, I lose my thought. Oh, 31 months. Okay. So 31 months. So 92,000. So 33, 59 plus 33. Okay, 92. All right, so cool. And now it's time to focus on the mortgage. And so let's go ahead and put this right here. 20000, 30 years at 6%. Okay. And then we're going to do this, find out the 31-month loan mark. So 93. Okay. All right. So cool. We got that. And okay. So now, one of the most important things that we have to understand is that when you understand the difference between, like, if the line of credit interest rate is way higher, so 6 to 9 is kind of a huge difference. You probably don't want, like, I can't see any reason why you want to replace this line of credit or mortgage the line of credit, right? If you do that chunking method that I talk about where you move parts of the loan, so let's say Like you move $10,000 to the line of credit and then pay it off. Like, so this will actually be 183. You'll get it paid off faster than you would if you replaced the whole thing with the line of credit. So I'll briefly demonstrate that. But luckily, when we have these huge amortized loans, we don't have to, we don't need a huge line of credit. We could just do it in pieces, right? And that's what this velocity banking calculator is going to demonstrate. So this is where I actually first learned velocity banking from, which is Renatus, which is a educational company. So if you ever enroll in these classes like I did, they'll give, they'll get, this is provided as part of their package. And full disclosure, I do make commissions from selling their education. So let's just go in here and just type in the information. So 193, what is the current balance of the loan? Okay. Oopsie, did I screw up? Okay. And the original balance is 200,000. Interest rate 6, 30 years, and then I have to 1.1. I think that's the payment amount. 1199.1. So 1199.1. And then what is our income? Is this right? 7,000, right? 7,000 is our income. And then 2,500 is our other stuff, right? So now, first things first, let's say, oh, what if we got a 9% line of credit and then did like a first lien HELOC to replace our mortgage, right? So I do 193,341.78. Okay. You'll notice like, hey, this looks pretty good because it's paid off in 4.4 years. And look at this, you only pay $41,000 of interest. Okay. But let's say we didn't replace our mortgage and we only just moved $10,000 into the line of credit, which we call it chunking. So 10,000. Look how much more you save. Like, why would you pay 41 if you could just pay 25 and this will go off a little bit quicker, right? So there might be instances where it might be appropriate to replace your mortgage line of credit. Maybe you have a really good introductory rate. Now, I know for myself, I applied for 2 HELOCs a long time ago before the interest rate hikes, and I got like a 0.99% introductory rate for like a year on my first HELOC and then like 6 months on the second HELOC. So there might be a case where like, hey, it might be appropriate, but I think for the average person, it's not going to be. All right. So again, you move $10,000 into that line of credit, paid off in 4.1 years. Ooh, look at that. We only pay 25K in interest. Oh man, that's exciting. And so now let's just do this. So what's 31 divided by 12 plus 4.1? So we paid off. We're debt free in 6.68 years. Oh my goodness. So that's 302K debt free in 6 point. What was it again? Man, I'm losing my mind. Plus 4.1. So 31. So 31 divided by 12. Yeah, 6.7 years. Or 6.7 years. So again, this isn't paying off the mortgage in 6.7 years. It's paying off everything, including the mortgage, right? And I feel like a lot of people, you tell them these things like, I don't think they're going to believe you. I feel like when I tell people in like a couple months, oh, I'm mortgage free, I think they'll just kind of ignore it. Like they almost kind of semi saw a ghost, but don't want to believe it, right? In fact, I don't think anybody will believe me. Maybe I'll post some screenshots and I'll be like, just kidding, it's Photoshop when it's actually real. Oh man, that'll be crazy. That'll be like a level, like an inception level of, I don't know, messing with people's brains. Or at least, I don't know. I don't know if people actually believe me. What do you think? You think people will actually believe you when you say, hey, you could pay off this debt pretty quickly, 6.7 years, including your mortgage, ha 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 ha. I don't know if people will believe you because every time I talk about velocity banking to the people I know, they just they just don't listen. But at least all of you on YouTube listen. All right, well, that's it for today. Have a great day, everybody, and we'll speak next time.